Hi everyone, this is Dan with Theta Trend again. Today is Tuesday, January 5th, 2016. It's 5:35 p.m. here. I'm in Mountain Time, so the market's been closed for a couple of hours. In today's video, what I want to do is talk about the Russell 2000 again, and then talk also about an adjustment that I made to the February CIB trade. What happened, as everyone probably knows, is we had this little sell-off here yesterday, and then today the market just sort of hung around down here on the lows towards the bottom end of this range that we've been watching from the 1100 to 1200 area, and not a whole bunch has really happened here today. You can see here this is dropping down to the 65-minute time frame. The market's just been kind of hanging out here. This recent move lower, I do want to point out, did create a new lower low on the daily time frame. But there's, I think, just a lot of uncertainty here. The tendency in the market right now, or the sentiment is very bearish. And, you have price here trap below the 50-day moving average, which is the red, the 200-day, which is the gray, and then this is the 20, the green, and the 10-day. So really price is pretty weak in here, and it's fallen down, but we are on this area of potential support. And I don't know, sometimes the market likes to continue lower, but other times it will really bounce back up and just sort of shake everybody out. And so with that in mind, this is the environment we're in, and certainly we could have a move lower, but we could also have that fast move higher. So in the case that happened, I want to talk about the trade that's open. So if we were to have a move quickly higher, what would happen? This is a picture of the February CIB. We would quickly start to go down money. This is the position as it sat today had I not done anything to it. And I actually made an adjustment to it, and I'll show you that here in just a minute. But my thinking in making this adjustment is I was looking at the position, and on the downside, I'm okay, I have some room to run. Somewhere in here, I'd be looking to take the position off and roll it down. And on the upside, what's going to happen is we're going to quickly start losing money due to the delta getting short on us. But also, we're getting a lot of support in the price here because of the implied volatility of this one long leg. So the implied volatility of this 1170 option gets pumped up, and that keeps the position looking healthy like this. But if we get a rally higher, that falls out, and our T+Zero line tends to sink on us. So one of the things that we can do is basically cut risk, and there's an adjustment called the Reverse Harvey. And the Reverse Harvey essentially just sells out these long legs. So in this case, you can see we have an option here at 1170 and 1070. It sells those out and it knocks them in a strike. So to the 1080 and to the 1160. So if we go down here, you can see, so this is the IWM, the long call, the Feb 116. I'm going to just go ahead and minimize that. And this is the RUT portion of the position. So as you can see, the day started out here, I had on the 1070 and 1170 options. They've been sold out, they're zeroed out, and now I own the 1080 and the 1160s. They're not checked. And the reason they're not checked is we're trying to look at this position as though I had done nothing. And so what we've done here is I've put in the 1070 and the 1170, and these are prices that I actually paid for these. These are not, things that I made up. So if we go over here, what I did is came over to the, the account statement, and I pulled the prices out of the butterfly that I'd purchased. So here the 1170 was at 58.20, the 1070 was at 18.15. So we go back over here, there's our 18.50 and our 58.20. And then the sale prices were the same process. So what happened is I sold those out and I purchased the 1080 and 1160. And so now I'm left with a risk graph that looks like this. So essentially, I've reduced the profit in the trade somewhat, but I've dramatically cut the risk. If we trade down here to this area, the 1085 to 1090 level, I don't expect to lose too much money, but if price trades way up here to that 1160-ish area, there's still going to be a pretty good open profit. And this is the point at which I'd be adding on another butterfly and getting ready to defend against a move higher. But this adjustment basically cut the risk in the trade and allows me to comfortably sit in it without a lot of concern about what's going to happen. The trade-off is obviously that the theta drops down. We gave up some of the profit that we would have made today, theoretically, but that's okay. I mean, in my mind, this is the type of thing that makes it easier to sit in this position because the directional risk is really minimized. On the upside, if we have an immediate fast move to the upside, there's very little that can go wrong. And on the downside, we still have plenty of time to react. And again, kind of my main concern here, that 1160-ish area, it's really not that far away. It's just a couple days away if we had some sharp reversal or something. So the reverse Harvey allowed me to sit in this trade and just kind of wait it out and see what the market does. And as an aside, just so you know, the way that I entered this order is as a condor. So you can see that's the order coming through here this morning, the condor to sell for 455 credit. I would not do this as single orders on the legs or anything like that. So that's everything I have for tonight. I hope it helps. If you have any questions, feel free to shoot me an email, info@thetatrend.com. Thanks for watching.